let's talk about the maybe messy report, the maybe mixed data that we've been getting as of late. We got PCE this morning. There's a lot to choose from here. I mean, as we're trying to figure out if the economy is still hot, right? We've sort of gone from a what kind of landing, no landing, whatever discussion to is the economy actually growing too much to be comfortable from an inflation perspective? What do you think?
Yeah, good morning. The data has been kind of all over the place recently. I do think that there are some signs that, the consumer is picking up in strength and some longer term signals that we noticed in some recent credit data that suggests that the consumer isn't nearly as stretched as it looked. But, we do know that even if we see in the jobless claims data that layoffs haven't really picked up, we do see a lot of other data, including JOLTS yesterday, to show that hiring hasn't really bounced back at all. So it feels like we're kind of, if you have to call it a landing at all, it's probably somewhere between soft and no landing. I don't think it really is cleanly characterized as either one. But it just suggests to me that we should be able to see continued growth along. I'm not sure we can necessarily repeat what we saw in Q3, but the consumer is still in very good shape. And I think that we'll see decent spending support growth in Q4 and into 2025 as well. If the Fed keeps cutting rates, then, all the better.
Yeah, and so one of the best pulses that we have been able to get at this time is really some of the jobless claims. And jobless claims, they actually came down week over week as well and below expectations. So all these things considered, is it possible that some of the hurricanes and some of the feared effects that are going to play out within these prints, or that we're anticipating to play out within these prints, might not spell out as worse a situation as expected? And then what does that do for the Fed's pathway? Do they just kind of continue full steam ahead in the direction that they were going, or do they need to kind of pull back and tamp down some of the expectations for future cuts?
Well, one of the things that Powell has been pretty consistent on is this notion that we should be data dependent, but not data point dependent, right? So if we do get a weaker payroll number tomorrow or an increase in the unemployment rate, I think that they would look through that, or I should say, even if we get a stronger number and a decrease in the unemployment rate, I guess this is actually kind of the angle that we're going with now. I would think the Fed would look through that for at least November. Part of their MO with cutting rates is not to try to save the economy, try to juice it back up. It's more just making sure that policy over the long run doesn't cause undue damage with some sort of lag that is difficult to understand. And I think that, given the claims data and how it's improved very significantly after a very brief spike, suggests to me that the impact of the hurricanes were relatively small on the labor market. Obviously, on an individual basis, that's different. But I don't think that there's much evidence to suggest that we're going to see a huge drag from people who, were not at work because of the hurricane. In order to not be counted on payrolls for this report, you would have had to, be paid weekly, which is not typical, and also not report to work for a single day during the survey period. The claims data does suggest that the maximum impact of the hurricane was felt during the survey week, but relatively lightly populated areas. Again, we saw ADP yesterday show that on the month, people seem to have come back to work. So I think that the impact of the Boeing strike is actually going to be more significant on the numbers, and we could see some distortion in the work week and average hourly earnings as well if people's shifts were shortened.
Tom, I'm going to take a little bit of a left turn to election land, considering that we're just a few days away from the election. I know you've been watching the consumer really closely. We know that consumer sentiment is very closely tied lately to which party one belongs to and affiliates with, right? So I'm curious if you expect any disruption to consumer spending sort of around the election and depending on the outcome of the election.
That's a good question. I mean, I think that is going to depend on not just who wins the presidential election, but also, of course, how things shake out with the House and the Senate as well. The biggest read-through for the election results into consumer spending in the future really has more to do with taxes than sentiment, because we are going to have this big rewrite of the tax code into, 2026. So that could end up impacting consumer spending if the Democrats do well. And then there's this concern that most of the Tax Cuts and Jobs Act is going to be reversed, or there's going to be additional taxes on upper income wealthier households. They've been the ones that have been driving the overall spending numbers to this point. So, taking away some positive, wealth effect, if you reverse that, then there is a risk that consumer spending might slow. But, as it relates to confidence, we have seen essentially since 2016 that there is this sort of, zigzag seesaw pattern of like when the Republicans are in office or are doing well in polls, the Republican sentiment goes to the moon and Democrats go into the basement, and literally vice versa. It's one of the more remarkable charts that you can look at that's really changed very significantly since Trump took office in 2016.
And what we've also been monitoring in the data as well is from at least Redfin's survey talking about how many potential home buyers, which is a measure that the Fed would be looking at here too. Potential home buyers are staying on the sidelines until the outcome of the election. How long will it take for the Fed to then get some more clarity around the housing market, for which shelter has been the stickiest component of inflation?
Yeah, I mean, for many months now, I've been more concerned about the upside risk to inflation rather than the downside risk. And shelter has been the primary driver of that concern. And it's not just the construct of the OER that has some sort of, mathematical quirk that's pushing up the CPI. It's really that the market is pulled tight as a rubber band. The rubber band is very tight now in terms of not much supply, still a lot of demand, and the potential that demand could very easily increase by a good margin once rates are a little bit lower. I think we saw in September, in response to the first 50 basis point rate cut, that there was a decent drop in mortgage rates. Mortgage apps and pending home sales were up a little bit during the month. They've come back a little bit as expectations for rate cuts have been tempered. And I'm not sure that the Fed is, necessarily going to be any better equipped to sort of understand how the housing market is going to evolve in a lower rate environment, because it didn't behave anywhere near how it should have in the higher rate environment, with supply going down more than demand.
Thomas Simons, who is the Jefferies senior U.S. economist. Thomas, always a pleasure to get some time with you. Thanks so much.
Likewise. Thank you.